Good afternoon, everyone. Thanks for joining us for the final SAM seminar of this academic year. And we are gonna take a summer break. Our next event is gonna be a workshop on July 30th on financial intermediation and security design. And the next regular seminar is gonna be on September 13th, in the next academic year. And one change we are making is in fall, the frequency of our seminars is going to be reduced from bi-weekly to monthly. So our seminars is going to be the second Monday of each month. Today, we are very happy to have Haoxiang as our speaker, and Haoxiang is going to present his paper, When FinTech Competes for Payment Flows. And we are going to follow our standard format. So Haoxiang is going to have 60 minutes for his talk. And during his talk, only panelists are going to be able to actively participate. And here you are seeing our list of excellent panelists. And after the seminar, we are going to have a 15-minute Q&A. And during the 15-minute Q&A, everybody is going to be able to participate. So as an attendee, you can raise your hand during the Q&A, and we are going to unmute you, so you will be able to ask your questions live. Or if you prefer, you can type your question in written Q&A at any point. And Haoxiang's co-authors are here as well. They may reply to you in advance of the live Q&A. So that's basically the standard format we are following. So without further ado, I'm gonna turn it over to Haoxiang. So Haoxiang, you have 60 minutes.
Great. Thank you very much, Samin. Really appreciate the opportunity, and it's great to see everybody online again. Hopefully, we can see each other in person very soon. This paper is about payments and about the FinTech. Joint work with Christine Paolo and Woody Rajan. I want to say that today I'll present some results that we're working on for the next version. So whatever currently in the paper in the public domain, part of it I'll present is the same idea, but the results and the model is slightly different. So it'd be great if you give me some comments on this kind of new results and new version of the paper. So to start with the motivation, what's the main idea of the paper? So we do have consumers, and we know consumers use services such as payment services. They have to make transactions, but also they need to borrow. So they are also kind of customers in the loan market. And a very important premise of this paper is that information in the payments are very informative about the credit quality in the loan market. So you can kind of figure out some valuable information about the person's creditworthiness from the transactions. And we typically think about this as a bank or a big incumbent financial institution. And the bank is going to offer both services, and there will be information flow between them so that the bank could use the payment information for making loan decisions. Now, what happens when FinTech firms come in and compete in payment? Now, when FinTech competes in payment, we get unbundled, right? So the payment services and the loans are potentially unbundled into two separate firms. Therefore, the information flow between the FinTech firm, between the payment space and the loan market are potentially disrupted. So there will be information that is diverted into the FinTech, and that does not make their way back to the loan market. So the question is, so how does this competition affect consumers? We are going to think about the loan market itself, the loan contracts, as well as the price of payment services by the banks. Now, the second question we are trying to address in this paper is what happens if information in the payment space find their way back into the loan market, right? Just like life finds its way, data finds its way. There are a few ways their data can find its way. The FinTech would sell the data to the bank, therefore the bank gets the consumer data. Or maybe consumers could port the data themselves because given PSD2 and GDPR, consumers are supposed to have a tighter ownership of their own data. And finally, maybe the FinTech firm themselves could start lending using their payment data. And we certainly see examples in practice of all these designs. And we're going to say something about how these three markets, data markets, compare. So as a summary of the results, there are three ways that FinTech competition affects consumer welfare. The first one is financial inclusion. It's a fairly straightforward argument. There are consumers who have high cost to access the current financial infrastructure, such as bank or credit cards. We can think about this as the sort of low-income households, or maybe in different countries, generally developing countries. So fintech competition in this space is going to provide low-cost access to electronic payments for these consumers. Therefore, it is a benefit. Now, the second dimension is the price of payment services by the bank. Now, the incumbents do not necessarily reduce their price facing competition. In other words, when fintech comes in, it is possible that the incumbent banks is going to increase the cost of payment services for the existing customers. Of course, they may reduce the price as well. And whether they increase or reduce it, it depends on the distribution of how consumers value this bank relationship, which we call bank affinity. Now, the third dimension is about information and how the loan market surplus is divided. In our model, when the bank has information about the consumer, the bank is able to extract a higher surplus. I mean, a higher fraction of the surplus from the entire loan contract. So there's a desire for consumers to hide the data. And the fintech competition makes it easier for consumers to hide the data by using an alternative payment method. Therefore, the bank does not see the full data. So that gives a micro foundation for privacy concerns. So that's the three dimensions in which fintech competition could affect consumer welfare. Now, what about data flows back into the loan market? We talk about the three, right? Fintech data sales, data porting, and fintech lending. Now, all three methods are going to lead to roughly the same outcome in the model in the loan market, because the creditor is going to price the loans with roughly the same information, because everybody's data is basically used to price their loans. So what it means is that the total surplus in the economy in terms of the loan market goes up. However, the surplus is not divided equally. In particular, lender surplus goes up a lot, and actually the borrower surplus goes down. In other words, the banks or the fintech firms, whoever making the loan, is actually making most of the money out of the data, whereas consumers do not. Moreover, if we assume that fintech firms are competitive, meaning they are going to reimburse whatever money they are making in the data markets back to consumers in terms of subsidized payments, then we can show that data sales and possibly fintech lending are strictly better than portability. Because in data portability, it is consumers who decide to share the data, and therefore they cannot really sell the data themselves. They would rather, in this case, prefer that the fintech firms sell the data on their behalf and give the consumers subsidized payment services. Finally, in terms of market share in the payment service market, we can show that fintech data sales is equivalent to data porting, and that is greater than fintech lending. In other words, if you ask the banks, out of the three, which one do you hate the most? The bank would hate the last option most. They do not want the fintech firm to actually make loans themselves. So that's the basic results. And for the next time, I will talk about, just give you a few slides of motivation and then talk about the model. Very quickly on the motivation.
I'm sorry, just one
point.
Lorena. I want to understand, what is your definition of bank? Is it a competition between fintech and banks, or it is just a competition between fintech that are just trading or active in the payment sector, and fintechs that are active both in the payment and the credit loan sector? What is specific here for banks?
Yeah, so bank here, we're using this as a term to describe the incumbents. In the developed country like the US or Europe, I would think about them as big banks and credit card networks. So Visa and MasterCard are also part of the incumbents.
But this from the empirical, okay, what you have in mind, but in your model, what is specific of a bank that is making it different than a fintech that is active in both the credit and the payment sector?
In the model, they will look very similar. So basically, what we call a bank offers a bundled service, with the payments and lending, where the fintech competes exclusively in payment. So I think this is what we have in mind, and clearly this, according to this FSB chart, is kind of consistent, right, with what the fintech firms are trying to do. we're talking about the FinTech, but also big tech like Apple, right, like Samsung or some other Chinese big tech firms. So they certainly compete in payments. And if you look across, there's a huge amount of competition right here in payments. And I guess once they get into payment space, they can offer a wider range for consumer services. So this kind of motivated why we sort of focus on payments. I see two hands, see Jonathan and Thomas. Yeah.
Yeah, I was wondering, so for certain types of fintech companies, right, there may be more complicated information flows than those on your diagram, right? I mean, that the core business of many big tech companies are already very data intensive. So they may possess some additional data not available to banks. Think of like Alibaba, right? They observe users' transaction history. So that may help them to offer loan services. And then another one is think about the big tech platforms, right? They may also benefit from the data that they can acquire from their payment services, right? Like when some people argue that Facebook, right, that why they want to issue payment services is indeed to acquire data, personalized data to enhance their ad targeting. So I was wondering, so indeed stable, right? Many of those big techs may be their core business, may bring in some another dimension to the trade-off.
For sure. I have to acknowledge upfront that in the model, we are not distinguishing the technology differences, although the model could be extended. I'll talk about this once we get there. The model could be tailored to model where the fintech firms have a better information, but then we would have to say the fintech firm would have a certain disadvantage. I would think that having a higher cost of capital seems to be a reasonable way because they do not have a deposit insurance. But that's something we can definitely do, even though we're not doing this right now. Thomas?
Maybe I just reiterate the prior points, but just to kind of understand. So the way you write a model, there is really fundamentally no, a priori, a big technological difference between banks and fintech lenders, especially if you bundle the lending and payment system together. That's essentially another. So I could think about this model as essentially a model of competition between lenders and the idea of sharing information between them. There is really nothing specific in terms of, on your side, of modeling some fintech advantage like on data collection, processing, or maybe regulatory differences that allow them to do something, you know, at a lower cost. Is it the first statement that essentially I could reinterpret all this model you're writing as essentially a model that bank is essentially an incumbent bank and fintech is essentially incoming bank, maybe a remote bank, maybe an online bank? But so the technology, it's really about competition between banking institutions or payment institutions, as opposed to really understanding some deeper differences on the technology side.
I mean, again, this is a fair point. I mean, if you believe this sort of necessary, we're happy to go that way. And I think for me personally, it's a lot easier to think about stuff with a kind of a concrete handle. And I think, you know, this is certainly broader than fintech versus banks. That I agree for sure.
Sorry, Haoxiang.
Oh, am I? Okay, so let's.
Yes, sorry, I didn't know how to raise my hand. Sorry. So I think very related to Thomas' question. So you just said this is a lot broader than the competition between fintech and banks, and then I have a little bit of difficulty like in handling this broadness because I agree with Thomas that this is a model of competition, but competition of firms who have access to a similar technology. While the idea of fintech is that they use, I don't know, for instance, soft information that banks are not using. I don't know, whatever they're doing. So how does this, and this model doesn't capture that, right?
So let me maybe talk to the model, and then by that point, we'll know better. I think the general idea is that indeed, it just, you know, one firm offers both services, the other offers one. And we're not modeling the technology difference there.
Nice to meet you, and great talk today. That was interesting. Oh. I have.
Go ahead.
That was it. Thank you.
Okay. Gregor has been patiently. Okay, go ahead. Gregor, please.
Just, yeah, a quick question. It doesn't seem to me, given that this is sort of the key thing is information flows from payments to make loans, it seems like this could easily be about asset management as well. I mean, asset management gives me a ton of information about your wealth, and that seems to be like really useful information for making, loans. What puzzles me is that when I think about sort of at least in the US, the entrance in the fintech asset management space, think like Robinhood or Wealthfront or so on, it doesn't seem like they do that much in terms of loans. So if this is like a first order thing that, this complementarity is like a first order thing for banking or financial intermediation, why do we see so many specialized fintechs?
I think the answer is, well, coming to the country only in my 20s, I think the answer is that all that development happened decades ago. So if we look at the countries like China, like Africa, I think that's when the financial infrastructure started to get developed, and people start to collect, credit information. So I think the U.S. already had that done, right, when the credit bureau was established. So I would say that in the U.S. market, the payment has been quite efficient already. I mean, in the sense, this is what I'm trying to do next. It's quite efficient already. So any payment services are really making the last mile, because you already can go for 8 out of 10 to 9 out of 10, or maybe 10 out of 10 to make it a bit more efficient. So I think in that sense, the additional information gathering is maybe not as salient as in other countries such as China or Africa. But I think the generic point I take it is that number one, this model could be used for any other two services that are related, and second, there is heterogeneity across countries of how big a deal it is, and we are just trying to build a generic model, and certainly how relevant it is sort of an empirical question, and we believe it is relevant, and it kind of could be connected to the fintech lending literature as well. But let's see the model maybe first. Okay, so this slide is meant to show that there's difference between countries, and certainly for developing countries, folks have been using the phone rather than the existing banking infrastructure to kind of motivate the financial inclusion point. And the last point, which I think is maybe also address Gregor's earlier question of why do we believe there's information in the payment space that is not already known. I think the first code is Black from 1975, because that is sort of an old idea that if information, if individuals route their receipts and payments through the payment account, then it can serve as credit information. And there's a bunch of empirical results. I have to say a bunch of that is done in Germany with the German data, and indeed banks basically get better information from the customers than non-customers. Gregor, feel free to jump in. I see your hand is still on. Okay, so let me talk about the model. I skip the literature in the interest of time, and certainly if you do have a relevant paper, please send it to me, because this literature is really evolving fast. Unless I do a literature review every 2 weeks, I probably would miss something. I'll talk about first about the model, and then talk about the bank as a monopolist in payments. Then we talk about how fintech competition affects the market outcome, and finally, the 3 forms of data markets. So here's the model. There's an incumbent institution, we'll call that a bank, that could be credit card companies. The important thing is that it is highly strategic, so we're going to think about this as a monopolist, right, if it is by itself. And then there are multiple fintech firms offering the same thing, which is payment. The bank offers both payment and loans, whereas the fintech firm only offers payment. We say two because we want the fintech firms to be competitive rather than kind of making a positive profit in equilibrium. And there's a unit mass of consumers. Everybody receives a value of V from access to electronic services, payment services, and they are heterogeneous in 2 ways. Number one, they differ in their credit quality. We call that a theta. There are 2 types, high or low. And the masses would add up to 1. So MJ of consumers have type J. Conditional on credit quality J, the consumers also have this bank affinity. Think about this just horizontal differentiation of taste. Some of them just like the bank. I'm sure whenever we go to the bank branch, we see someone really enjoy the conversation with the bank teller, and we're in the queue. So the distribution of bank affinity is F, conditional on the type theta. So that's the 2 differences across consumers. Thomas?
Let me just ask you one question about this modeling assumption. So I understand that you want you have like a banking sector and there's an FinTech. You know, at least like in the US market, there are thousands of banks that also compete with each other quite aggressively.
Yes.
So how important is this assumption that there's essentially a single bank? Like, would we just like,
it
would
is
this thing sort of work if you say have three banks competing with each other and the FinTech enters, would it just be the fourth lender? And you think the results would be more or less the same, or it's just want to kind of understand this. I understand for simplicity of the model, attractability, it kind of makes sense, but.
Yeah, it's a fair point. I think the only thing that matters here is that banks have market power. We just want the incumbent to have market power. If they do have market power, and if we have thousands of them, so what can happen is that consumers probably have some taste about one bank versus another. So the preferred bank would again have some market power. As long as they do not compete away all the profits, I think is the model would go through. I mean, which is true, right? U.S. banks are some of the most profitable firms in the world, so they do have a lot of profits and they do have market power. So for simplicity, we're gonna put them into one umbrella, and of course, if we have multiple, we're gonna just reduce their pricing power proportionally, I guess. I think qualitatively that would be similar. Okay, so the model works as follows. Go ahead.
Igor, coming back to Tomas's question, in your introduction, you said that the best consumers want to hide their information from the bank. I think in the competitive model, so that's where I don't know how much that would survive if you went away from a monopolist, because best consumers want to be able to signal to competing banks their true quality. So I think when it comes to distribution of gains from informational losses, let's say, I think that will be very sensitive to your assumptions of competition. Or what am I missing?
I mean, this result certainly is. I guess I can defer this until we see the model. The model is based on screening.
Sure.
So the idea is that the high types would earn some information rent in the principal agent problem. And as soon as the high type loses that information rent, the utility of the high type would go down. Now, of course, one could construct a different model in which the high type actually get better deals. I think we can do that. And again, it is sort of an empirical question of which way it is. I think we're not trying to get all the dimensions, but we just try to, in a sense, microfound one possible concern of privacy. Why do people not give their data, even though they are apparently high credit quality? This is one possible reason. I'll get to more specifics into the model details if that's fine.
Okay.
Lorena. Okay, Lorena just disappeared from the screen.
We know empirically that one of the key aspects in terms of value also for information comes from the network. So it is true that there are a lot of banks, but as soon as clients it will be difficult to pry away them from one bank to the other. Then I think that your assumption that the incumbent bank is a monopolist, at least for the subgroup of clients where they are having relationship or some type of, let's say, of network activities, it is quite acceptable, even if there are other banks in the market.
Thank you for this comment. I agree. For consumers, at least in the US, we say, okay, why not the credit score? That's because the credit scoring system has been in place for decades. But if you think about the businesses, I think the business credit score system, the credit system is more recent, even in the US, right? So in that sense, we could say, hey, if you're a small firm, having this relationship with the bank is very important because the bank sees your information, whereas others do not. So for that, I completely agree. So let's talk about the model timeline. It's pretty straightforward. In the beginning, each consumer knows her own type, credit type theta, and also bank affinity or taste of the bank B. And the consumer is going to pick one of the firms as the payment provider. And importantly, if the consumer chooses the bank for processing payments, then the bank also observes the information. So the bank would become informed about the consumer's credit type. Otherwise, the banks.
John, can I just ask about that real fast?
Yeah.
Is that true independently of whether the menu that they're going to offer is separating or pooling? Like in pooling menu, you wouldn't be able to tell the two types, but you still observe the theta?
Oh, so no. Well, in this case, the menu. Well, first of all, the menu the bank provides will be a separating menu, and the second, the well, in equilibrium, and the second, in this model, we're assuming that if you see the data, then you see the type. So even if you offer, so the menu you offer depends on the information, not the other way around.
Because the theta is the probability you default, was that right?
Probability you repay. Probability you repay. Yeah.
Yeah. So okay, but okay, so it's not based on the outcome. It's just somehow they just see your theta.
They just see your theta. Yeah. If they see you made a trip to Vegas last month, they reduce the theta. For example. Okay. So at time two, with constant probability, the consumer needs a loan, and the bank would offer a menu. Now in this model, by the way, at this point, the bank is the only lender. So the bank would offer a menu which depends on the bank's information. So there will be consumers who use the bank, right? So for those consumers, the bank offers a menu, and for other consumers who do not use the bank for payments, the bank offers different menu. So that's what it means by depending on the information. In the end, consumers either repays the loan or default. So let me first talk about the loan market. I think this is should help address some of the questions and concerns about how the loan market screening works. So here's how we sort of model this. The profit of a consumer of type J by accepting the contract Q quantity and interest rate R is equal to the probability of repay times the return A times the quantity minus the probability to repay times the quantity times the 1 plus the interest rate. So that's basically theta multiplied by A minus 1 minus R altogether multiplied by Q. There is a quadratic penalty for defaulting, which happens with the probability 1 minus theta J. Now, conditional on the type theta, the bank would make a profit that is equal to condition on theta, right? That's theta is probability to repay, and that's how much the bank gets back, minus the principal. We're assuming normalizing the bank's cost of capital is 0, minus the capital cost, which is increasing in the squares of Q, right? Just make the solution linear. If we solve the first best, that's going to maximize the sum of W and pi, and the first best quantity is going to be this expression. We can see obviously it is increasing in theta, and that's in a sense what the only thing that matters, right? One could change, the different assumptions on lambda. For example, what we could put a 1 minus theta here. It doesn't really matter. The end result is that the quantity is increasing in credit quality. So here is how the bank screens consumers. At the uninformed bank that does not observe the data, let's assume that in equilibrium, there are mu H, high type consumers, and a mass of mu L, low type consumers coming to the bank. And the bank doesn't see the data, so the bank would screen by offering a contract H and L. In order to maximize the total profit, right, that's the mu times the profit condition on type, subject to 4 constraints. This one says the high type should not imitate the low type. The second one says low type should not imitate the high type. And the last two says both types are at least as happy to participate as not participating. So participating constraints. Then it would not be surprising that in the solution, we would have the sort of the usual way of the solution. That is, the low type get held down to the reservation utility of 0. Okay, whereas the high type get offered a contract that's equal to so that it makes the IC constraint binds. So the high type just doing as well as if the high type is imitating taking the low type's contract. Also, it is sort of standard intuition that the highest type is not distorted in quantities. So the high type got offered the first best quantity right here, whereas the low type get the quantity distorted downward. The intuition is that in order to prevent the high type from accepting a low type's contract, the principal, namely the bank, wants the low type's quantity to be not as efficient, so that the high type would prefer not to imitate. And how much distortion there is depends on how many high type versus low type the bank faces. The higher is a fraction of mu H over mu L, or the higher is the fraction of theta H over theta L. Then the high type, the bank is likely to make more profit from the high type Therefore, the bank is more kind of worried about high type imitating. So it's going to make the low type quantity distorted more aggressively downward. So we can rule out the other possibility, but this is basically the solution. So I see Tamas and then Igor.
Just
let me try to slow you down.
Like when in terms of the relationship of theta to bank affinity,
yeah,
because I think it might matter also for your like welfare analysis. Like it's currently in the base model completely orthogonal, so I might love the bank, but I have high low theta, or there is a relationship between these two. Because I think some of your welfare results would also probably depend on bank affinity, and then how we think what bank affinity is would be kind of important, I guess.
The good point. So the bank affinity have a distribution that that depends on the type. So this really F theta of B. Sorry about my terrible handwriting. So it depends on so B depends on theta. So we allow for that.
Sure.
Yeah.
And the results would probably depend, right, on what you assume about the distribution, right? Whether people say that a high theta have higher or lower bank affinity on average and so on, right?
It does. So the outcomes does depend on the different distribution assumptions on F. I'll show you some charts. Yeah.
Perfect. Thanks.
Is it supposed to be obvious to me why the load? First of all, are the load types high default probability or low default probability?
The low type has a low repayment probability, so they are low credit.
They're the bad type. How come they're the ones being kept indifferent between participating and not? I'm kind of used to it almost being the other way around. These are the guys who are being cross-subsidized. Or
I mean, why would you? So, I mean, one could prove it, at least in this model. The first bias quantity and also the profit, I guess. What I'm trying to say is that, you know, if you are the high type, for the given Q and R, you know, if you're the high type, you would get a better utility, you know, than the low type. In this model, this equation holds, and one could show that you don't want to hold the high type to the reservation utility. I thought
is it differently. Are you?
Yeah.
Did
Sorry.
you get separation by assumption, or so? Could there be a pooling equilibrium which would make everybody better off?
Better off than
separating.
Than the separating.
So could I open a bank? Oh, sorry, there is no competition. This is a monopolist. Sorry, I keep coming back to. I'm used to models with competition. I think I'm getting there. Sorry.
No,
I'm not so sure. Wait, even without competition, is it obvious that with a monopolist that they don't want to deviate to a pooling? Is it linear? Their payoffs are linear.
I thought it is. Well, I mean, you can correct me if I'm wrong, and Woody, feel free to jump in. I think in this sort of models, generally the efficient contract is that the types reveal themselves. You would have a direct mechanism that, you know, it's almost like the types would announce, okay, I'm the high type or low type, and then you get the contracts. And the pooling one.
Not if you have very few bad types. Then
exactly.
Then it's a lot easier to pay them off.
Yeah, if you have very few bad types, what it means is that the mu L is very small.
Yeah.
Right. So in this model, you would really distort the low type. Because if you do not distort the low type, then the high type might pretend to be the low type. So if you are pretty sure that most of your types are high, then you're going to distort the low types really aggressively to make sure that the high types sort of stay in line.
Why not just give the high type their preferred allocation and pay and subsidize the crap out of the low types, because who cares?
Yeah,
So I think in this model, you can show that starting with the pooling outcome because of single crossing, as a monopolist, you can always find a small deviation away from the pooling outcome that leads to the bank making a higher profit.
Even the monopolist? Because usually there's like the cream skimming when you have at least two.
Yes.
Two banks, but that's true. Okay.
Yeah.
You guys go on. I'll think more. Sorry.
No worries. That's an important point. We should definitely now clarify this. Okay, final slides on this kind of long screening. How do we pin down the interest rate? The interest rate for the low type is pinned down by the participation constraints, because we know QL, which is distorted downward, And from this equal to 0, we can solve RL. Once we solve that, we substitute everything to the right-hand side, and we already know that the QH is the efficient outcome, and we can solve RH. And it is convenient to just write the utility of the high type rather than interest rate, because we are interested in the utility after all. In this case, the information rent or the surplus of the high type in the loan market is entirely dependent on the low type's quantity times this constant. So the intuition is that the high type would suffer a lower default cost than the low type. So that's kind of the source of the information rent, because the default cost is proportional to lambda times Q squared. And that is clearly increasing in the low type's quantity. Okay, so the bank's loan market profit is going to be the first best minus WH. And whereas the bank's profit for the low type is actually the whole thing, because the low type get held down to the participation constraint. So the low type gets 0, and the high type gets the entire surplus in the loan market, even though the surplus is actually distorted downward. So that's basically it for the uninformed bank. Now, what if the bank has information? And I think this is where so the model is, we use this fairly reduced form way of modeling this. The assumption is that if the bank observes the data and therefore knows the type of the consumer, then the bank's going to update the prior ratio of high to low, that's the likelihood ratio mu h to mu l, into mu h over mu l times alpha, where alpha is a number greater than 1. If the bank observes the consumer is low type, then the bank's going to update the likelihood ratio from mu h to mu l and downward into mu h over mu l divided by alpha, where alpha is greater than 1. So think about alpha to be infinity. For now, I think this is sort of easy to think about. Then you kind of tell the two types for sure, right? And also for intermediate alpha, I think this is one possible way to model the difference in technology. If we go that way, it seems to be there's some interest sort of seeing that kind of model. If the fintech and the bank have different alphas, then they essentially have different kind of technology, different precision to tell the types. Just want to emphasize that once the bank observes the credit quality of the consumers, the bank is going to price discriminate. In other words, the menu of contracts offered to the high type likely consumers is going to be different from the menu of contracts offered to the low type likely consumers. So that's represented by this difference, whether it's K over alpha versus the K times alpha. So again, I guess these two we talk about at the end. Okay. So now let me talk about the bank monopolies in payments. Just very few slides, and then talk about the fintech competition. So the general idea here is that the bank charges a fee of P for payment services. It could be fee or it could be interest rate spread, way below the market spread. We're going to use the superscript I to denote informed and the superscript U to denote uninformed. If the consumer with the type J and the bank affinity B uses the bank, her profit would be V, that's the value for payment services, minus the price, plus the bank affinity. Remember, she enjoys going to the bank, plus the probability psi of getting the loan, of needing the loan, times the surplus W of going to the informed bank. Remember, because she goes to the bank, therefore the bank prices it as informed. If the same consumer uses cash, she would just get this part. Doesn't have any V, P, or B, but rather just the uninformed surplus from the bank. And the consumer, therefore, chooses bank versus cash if and only if her affinity is at least this high. So that has to do with the price and the service value of electronic payments minus fee times the difference in the value of delta JW. And in equilibrium, it's likely that the delta HW is less than 0, even though in principle anything could happen, but I think this is more likely to happen, whereas delta LW is 0, because the low type always got a 0 anyway. The high type could suffer a bit from information, giving the information to the bank. So how the bank offers the kind of chooses P, the payment service price, depends on the mix. And this chart kind of represents the type of consumers the bank sees. So we are showing the high type consumer, low type consumer in 2 lines, and that's the 2 cutoff points. So if your bank affinity is above the 2 cutoff points, then you are going to the bank. Otherwise, you stay with the fintech. Now the two thresholds are different because the delta W, I guess, the difference in the loan market surplus are different between the high and the low. So the bank is going to get the light shades, and for these guys, the bank will charge the price of P, and the bank will get the informed profit as if you get the informed profit, except that for these guys, namely for these crosses where the consumers that not going to the bank will not get pi I, rather it gets pi U. So essentially you just take out the delta pi. So that's the bank's information, sorry, the bank's total profit. This model is quite involved because as you can see that all the pies depends on exactly mixing, right, of high versus low type consumers. And therefore it depends on the P itself and it depends on V. So that's why all the equations are a little involved. I think this is where this version of model gets a richer set of results, but also kind of making this, the solution is really complex. So the first order condition would be quite involved, and I'm not writing this down. But basically how we solve it is that numerically is just to choose the candidate P and solve this delta W and then solve everything else and see, if we can maximize it. That's basically how we solve it now. We are hoping to get more analytical results, in a couple weeks if we manage to get it. Now let's talk about the fintech competition in payments. So in that model, right, with the bank being the monopolies in loan and the payments, let's add in the competition in payments only. When fintech comes into the market and only offers payments, it also offers the V, remember, right? And we assume that the fintech chooses the price of 0 for offering payment services. So what would you get, right, if you are a consumer that kind of uses the fintech? You would simply get a V. There's no P and there's no B, and you would get a phi times delta J of WJ of I. Somehow I have difficulty erasing this. Got a WJ.
I ask a question.
Okay, go ahead, Daryl.
Why the emphasis on competition in the fintech sector, given that fintech payments involves a lot of network effects? You would kind of get concentration in that industry, like Alipay and WeChat Pay, which I think charge 60 basis points for payment fees. Why do you emphasize so much competition in fintech?
This entirely fair point. So for now, we think about the fintech as new entrants. They offer the only service they offer is payment. So that's the homogeneous services. Therefore, they kind of compete down to cost. It's true that Alipay and WeChat Pay charges more, but I think this is after a round of consolidation of third-party payment services. So I think it is quite common for the tech companies to first charge basically cost and give you a huge subsidy, and once they clean up the market, they would come into this position of dominance. We are sort of modeling the point when they are kind of entering the market. I think you can also see this in the Chinese context. If you get this shopping websites, you got thousands of platforms, really chaotic. In the end, you basically get 1 or 2 winners remaining, and they start to have a huge market power. So we are kind of modeling the initial stage. But you're right. I mean, they certainly have market power now. That's why regulators are trying to deal with them.
If you're modeling the transition, then the implications of your model only apply during the transition. Do you expect that to be a change the structure of banking in a durable way, or should we think of your results as only applying during a short period of time?
I think this certainly applies to that transition period when a lot of empirical study sort of have already looked at. I think the point when they started to compete as like big tech versus big finance, we might have to go to the model angle where the big finance would have, say, balance sheet advantage, whereas the big tech has technology advantage. So there's some kind of heterogeneity becomes necessary, I think, for us to say more over there. And it is also a kind of highly political point because it is still going to be being debated. We are happy to go that way. But right now we're just being sort of models and how in that modeling approach, trying to kind of figure out the initial stage what happens. And indeed, later when we talk about the data markets, I think the evolution there is also salient because we know that fintech naturally become data sellers and naturally become lenders. Yeah. Okay. So in this case, the fintech would choose the bank to fintech if her bank affinity is at least this much. So that's PC. C is competition, and here is the change or the difference in the profit of the consumer. Going to the informed, meaning the bank, versus the uninformed party, meaning the fintech. We can show that the cash is dominated. Now, if we sort of compare BC versus BM, sorry for scrolling. The only difference is this V, right? So basically, we can derive this competition case by setting the value V to 0 in the monopoly case. So here's the illustration of the solution, showing that in this model, anything could happen about the prices. And we are using the parameters shown on the slides. We are fixing the low types distribution to be exponential, affinity distribution to be exponential, and the bank's affinity distribution for the high type is actually a Weibo distribution. So k equal to 1 means it is exponential, and k greater than 1 means it has an increasing hazard rate, whereas k less than 1 means it has a decreasing hazard rate. And we can see the ranking of the monopoly price and the competitive price are generally ambiguous. We are hoping to get a more analytical solution to show this, even though it's a little challenging right now, where we're trying to do our best. So what about the fintech competition on loan quality and quantity? We can basically put out all the expressions, and we just use the numerical solution. So here, the blue denotes bank monopoly, and the red denotes fintech competition. Again, the result seems to be either direction could happen. On the left, we have decreasing hazard rate for the bank affinity distribution of the high type. We can see that after fintech competition comes in, the curves start to shift down. Okay, you see the red is below the blue. And as expected, we have the monopoly in both the monopoly case and I'm just highlighting this, and the competition case. The loan quantity for the low type is actually higher if the bank's informed, right? This is very natural. And on the right-hand side, for the increasing hazard rate, we can see that fintech competition is going to shift up the loan quantity, right? So the loan quantity goes up, whereas here loan quantity goes down. So this slide shows the.
So Haoxiang, sorry to interrupt.
Oh yeah, wait, go ahead.
Can I clarify a bit? So I'm not sure, I might have missed something here, but I thought it's useful to clarify. So when fintech company compete with the bank here, do they compete equally, for high quality versus low quality borrowers here? So I thought at least in the Alipay data, it seems like competition is mostly for people low or kind of at margin kind of borrowers, right?
This is an entirely fair point. So in this model, the fintech competition, they basically grab a different share of high type versus low type, because the high type and low type have different values in given the data, essentially.
Right.
I think in Alipay, is slightly different in the sense that the Chinese bank system sort of, it's difficult for them to offer credit to the low type guys. So there are some frictions, and I think Alipay is trying to eliminate that friction by using the information that they gather from the different platforms.
I thought your model actually takes care of that, right? Because high credit worthy guys go to the bank because they want the bank to know their type. So the fintech firms are left with the low credit worthy consumers. So in that sense, it's consistent with what Wei was saying.
Well, in this case, in fact, in most of the parameters, I mean, if alpha is high enough, we have the high type guys. Actually, they do not want to go to share the data. Again, the reason is that once they share the data, they do not have any information rent when the bank starts screening. So it is the low type guys. Low type guys are actually different, but high type guys have a stronger incentive to hide the data, kind of giving rise to this privacy concerns. But again, I think this is sort of a result of the way we set up the screening model. If we set alpha to be greater than 1 but not too high, one could get either this way or the other way. In fact, we could get it both ways, even though when information gets perfect, the high type guys do not want the FinTech to have the data. Sorry, do not want the bank to have the data.
I see, but that sounds like it depends on the modeling assumptions that the high type, once the bank knows the type, then they get like an interest rate which extracts all their surpluses.
Yeah, I mean, intuitively, we can sort of think about this chart, right? Intuitively, the high type would prefer a segment either, on the left or the right. The high type would prefer a segment that's sort of, more favorable to them, because the screening by the bank sort of depends on the high-low ratio. And clearly, because the FH and FL are different, one could get anything in this case, right? In principle, the high type could want the FinTech or could want the bank. It's just that when alpha is very high, we know that the bank would get all the information and therefore price everything as a monopolist, truly a monopolist, and all the surpluses went to the bank. But when alpha not high enough, we could get it either way.
So sorry, I want to follow up on Emery's questions about the model setting. It seems like in your model, the bank's information about the high-low type, they are kind of similar, right? But could you sort of, but on the other hand, there's this monopoly power by banks. Could you sort of have a different setting where actually, banks might have better information about high type, but less informed about the low type. But then, then you will see sort of very different outcome, right? Then FinTech company come in because the payment system provides information about all types. Then, right? So then naturally sort of they're going to complement banks on loan types better.
Oh, this is a great point. Yes. So you are saying that, I mean, in the model, there can be different alpha for high versus low. If we think about the low type as no documents, if a bank can only process documents, whereas a FinTech could also see what kind of app you use. Indeed, that's a good suggestion. Thanks. Then in that case, indeed, I mean, even if alpha becomes really high, it is still possible that it is the low type that sort of truly benefit from the FinTech competition. Okay, great.
Haoxiang, just a reminder, you have 12 minutes left.
Okay, thank you. Okay, so just like the loan quantity, the surplus of the of high type could go either way. I'm spelling out the expressions here. The only thing I just want to emphasize is that everything really depends on the ratio, right, of people that the high type is sort of mingled with, right? That's high versus low, depending on whether they use the FinTech or the bank. So their loan terms entirely depends on the population that the bank sees, high versus low. Because the distributions FH and FL are so flexible, generally we could get the ranking either way. And indeed, that's the case. So you can see on the left, for decreasing hazard rate, when FinTech competition comes in, we can see that the surplus of the high type shifts down, so the red is below the blue, whereas on the right, the red is above the blue. So I think this is one of the features of having a flexible model is that anything could happen. And I think maybe the connection is to sort of look at the data and see, well, maybe this outcome happens, therefore it infers a particular feature of the parameters we're looking at, if we are willing to sort of take the model more or less literally. So just to summarize, what about the total consumer surplus? So we know that the low types in this model, because of loan screening, got a 0. They are held down to the reservation value. So their welfare depends entirely on the payment market. For the low credit consumers and the low affinity, so low credit and low affinity, they are strictly better off because they get the payment service value of V, right? Before FinTech comes in, they use cash. So that's the inclusion point. Whereas for low credit, high affinity consumers, their welfare depends entirely on whether the banks raise or reduce their payment service prices. It is possible that the competition kind of reduce price, so they are better off. It is also possible that competition raises the bank's price, in which case they are worse off. Now the high types, again, is a little more involved because for the high type, they get some surplus, right, in the loan market. And even if they are have really low affinity, the loan surplus in the market differs depending on whether the FinTech's there or not. And again, we are showing the charts. Blue is monopoly, red means competition. When competition comes in, we can see that on the left, it tends to shrink the difference between the high-low, high B versus low B high-type consumers, whereas on the right, it also shrinks, but it sort of lifts everything up. So I think for the high type, it's a little more, it's a little trickier. So in terms of economic channels, I think I have shown the three. Even though sort of ranking them is a little tricky if you want to do it unambiguously, but the channel hopefully is more or less clear. The inclusion point is that it really benefits the low affinity guys. So these consumers have high cost of access to the bank, so therefore they benefit a lot by using the fintech. The price of payment services could go up or go down depending on the bank affinity distribution. And finally, in this model, loan surplus goes mostly, more information in the loan market means a larger fraction of the loan market surplus goes to the bank. So there's incentive for the high type consumers not to give the data. In that case, having the fintech competition actually benefits the high type because they can avoid giving the data. Even though we have to acknowledge that the delta H, this delta HW, generally have ambiguous sign. Loan volume is ambiguous. So that's that. Finally, in the last few minutes, let me talk about the data markets. So this one is actually fairly straightforward compared to the fintech competition case. There are three different settings. Data sales, so the bank would purchase payment data from the fintech and use that to price the loans. The bank remains the only lender. Or the consumer could use their own freedom, right? They can choose whether to pull data or not. And the bank, again, remains the only lender. Finally, when the fintech also makes loans, it's going to compete with the bank in two ways. Let's look at the data sales first, okay? So when the fintech purchases data, when the fintech payment customer approaches the bank could buy the data from the fintech firm, saying, okay, let's get the analytics from Alipay or from WeChat Pay and figure out how creditworthy this guy is. And that data is actually creates additional surplus because more information is going to reduce the distortion, right? Remember, reduce the distortion, at least for the low types loans. We're going to leave the bank and the fintech to figure out the division of the surplus. But here, the assumption is that when the fintech firms are competitive, they are going to anticipate this data sales revenue later. So ex ante, they are willing to reimburse the consumers in the form of a subsidized payment services, right? So the price is no longer zero; it's actually negative. Even though it sounds a little stark, but think about this: the change, the payment service become even cheaper. So the bank becomes informed about all the consumers and strictly benefited from data sales. And the consumers always get the informed surplus, regardless of whether they use the bank or fintech, because their data will eventually flow to the bank. So if we denote by Y the price of the data per consumer, so in the end, we basically solve this thing. It's pretty similar to the equation before, except that here, the cutoff type of the consumer who is indifferent between the fintech and the bank is given by PS plus psi times Y. And the bank makes money on these guys through payment services, and it also makes money on the loans. Now, the simplicity of this equation is that all the pies now do not depend on P's. The reason is that the bank would get all the data, so the bank would price everything according to the prior ratio MH over ML, rather than the two different populations, because the bank gets all the data. So this is why the model with the data sharing is just a lot easier to solve, because all of these, all the pi is actually constant. So what's the impact of data sales? I'm gonna talk about this in this table. Think about the high credit quality, high theta, and the low bank and high affinity guys. Okay, so in the loan market, if alpha is high, then they are worse off, because the higher surplus, a higher share of the loan surplus all go to the bank. In the payment markets, that really depends on whether the data sale price versus the monopoly price, which one is higher in terms of in the payment markets. So the total is ambiguous. Likewise, for the low bank affinity guys, they're actually better off because they get a V. so adding up these two, this again ambiguous. For the high bank affinity guys but low credit quality, in the loan market, they got a flat or basically zero surplus anyway. So everything depends on the payments, and that could be ambiguous or better off. At least with the FinTech data sales, a subset of the population are strictly better off, and that's the low credit quality and the low bank affinity, namely the high cost to access bank. So these used to be excluded from the economy, but now they kind of get in and get the benefit not only in the payments, but also in the sense in the loans. So okay, do I have? So can I take a question? Yeah, is it okay if we defer question in the end? I see Robert and Leanne. Just a couple of slides, and then I'm done. Now with the data portability, I think the intuition is extremely similar, except that consumers now port the data rather than the bank buy the data. Now what's the difference? The difference is that when consumers port the data, the banks get the data for free rather than at a price, okay? And it is at least conceivable that the bank is going to offer a bit of an incentive for the low type to give them the data. Now, in that case, the high type would have to give the data as well because they are singled out. So that's what we mean by unraveling. As the low type give the data to the bank, the high type would have to give the data because otherwise they are inferred to as high type anyway, right? So whenever a subset of a population share the data, the other part sort of is forced to be revealed about their own types. Now, the difference between this case and the previous case is that right here, we got a certain population that is strictly worse off. That's the high credit quality, but those who do not like banks. Okay, this is because they get a payment service. They do not get a subsidy on the payment service because they share data for free. And in the loan market, they get a worse. They get a worse outcome because the surpluses went to the banks. I'm going to skip the equation. It is possible to show that, in fact, the portability price is strictly higher than the FinTech data sale price by this psi times y. And we can also show that these two markets actually look very similar because bank market share is identical between these two market structures. In one, the portability part, the banks actually charges more for payment services because the bank understands that people will come with the data anyway. So the bank does not have to set a lower price to encourage people to become a payment customer. I'm kind of short of time, so just very quickly with FinTech lending, I just kind of verbally describe the logic. What happens if FinTech lends, assuming they have the same alpha, okay? Now ex post, the consumers would get liquidity shock and want to borrow. We know that the high type would want to go to one of the lenders that have a more favorable high to low ratio, right? Because everything depends on the high to low ratio in the loan screening. And the high type sees the two lenders, right? The bank and the FinTech. Obviously, the bank would, so the high type consumer would go to the one with a more favorable one, with a favorable ratio. And in equilibrium, the high type would flow in such a way that the high low ratio between the FinTech and the bank are equal. It has to be the case in equilibrium. Otherwise, the high type would actually flow. What this means is that the high-low ratio in both lenders is exactly equal to the prior because the sum has a ratio of MH over ML. So that essentially means that all the contracts are offered identically, right? So the bank and FinTech offer exactly the same contracts because the high-low ratio of the consumers are exactly the same. And a certain additional assumptions such as FH equal to FL, we could kind of write down the equation more explicitly. But in the interest of time, let me skip it and come to almost the last slide. How do we compare the three data markets in terms of loan market and payment market? In terms of loans, they are truly identical to consumers because consumers are priced in the loan market by the informed lender one way or the other, and the loan contracts only depends on the prior distribution of high versus low. In the payment market, the subsidy to consumers actually tends to be the highest when FinTech makes loans because the competitive FinTech is going to reimburse the loan market profit back into the consumers in terms of subsidized payment services. Data sales is second to the extent that data sales only give the FinTech a share of loan profit rather than the entire thing. And data porting is actually gives you consumer the worst price. Now, in terms of the bank's market share, fintech lending is lowest because the bank not only loses payments, but also loses lending. In other words, when the consumers can also borrow from the fintech, their incentive to go to the bank and therefore become bank customer becomes a lot weaker. Whereas data sales and data porting give us identical market shares for the bank. To summarize, the premise of the model is that payment data has information about credit. And when fintech competes for consumers in the payment markets, it reduces information of the bank in the credit market. When too much information reduces the high credit types consumers surplus, sort of hiding the data in the fintech is actually generally advantageous for the consumer. So that's a positive micro foundation for privacy concerns. I know that privacy sometimes has, discussed in the context without money, but in this case, there's an economic reason not to share data. Fintech firms also promote inclusion by giving consumers that have high cost to access banks the ability to use electronic payments. But the price of payment services is generally ambiguous after fintech competition. Data sales, portability, and fintech lending all give us the same outcomes in terms of the loan market, because everybody got a price as if the lender is informed. If the fintech is competitive, data portability is actually worse, namely it's dominated by data sales and possibly fintech lending. So that's about it. Thanks a lot for the comments.
Thanks, Haoxiang, for the great seminar. Now we are going to move to the Q&A. So both panelists and attendees can ask questions. So if there is any question from attendees, please raise your hand and we are going to unmute you. And Robert and Lian had a question. We can start with them.
Please go ahead.
Sure. So maybe, I mean, this is kind of a version of a question that's already been asked at the very beginning and then sort of later on, and maybe a little bit of what you did at the very end kind of tries to answer this, but there's a big asymmetry, right, between the bank and the fintech in terms of like the fintechs being viewed as competitive and the banks not. But it seems like at least your results that you were talking about, how the good credit quality customers can wind up being heard relies, at least it seems to me like it relies on the fact that you're treating the bank as a monopolist sector. Like if there was competition there, like it seems like that effect would be unlikely to be there. And so to the extent that you have a model that like anything can happen, it feels like anything can happen because you're kind of shutting down competition among the banking sector. But that sort of reversal effect would no longer really be there at all. But maybe I'm wrong about that. And again, like that's something that I think other people have kind of asked in a similar way.
It's entirely fair. I think in the current model, if we push this information precision to infinity, then indeed the high type is worse off. But again, if being informed simply means you just get a bit more information, because the distribution is so flexible, you could get it either way. Maybe we should sort of explore more and what conditions the high type is actually better off, because that is indeed possible. If you set alpha to be say 2 rather than infinity, we could get parameter regions where the high type is actually strictly better off because the selection is more advantageous to them. So I think the bank competition, if we weaken the bank competition, let's say instead of having the bank as a monopolist principle, we say the bank would only take a certain fraction, right, of the total surplus, then indeed I agree with you that the effect would be weakened. Yeah. Okay, Lian and then Wei.
Hi, Haoxiang. So when you talk about the data sales section, I have 2 questions. The first one is, so what's the implicit assumption about the data ownership? So who will have the data in the first place, whether that matters in the settings? So probably it's kind of because of cost theorem, maybe that does not matter. But according to your description, it seems that the consumers have data in the first place, and then the fintech firm is trying to buy that. So because the data is produced in the process involving of many parties, we don't know, so kind of unclear who owns the data in the first place. That's the first question. The second one, so when you talk about that the data, the price of the data implicitly assume the price for each data point is the same. So I think about whether the data price can be different depending on kind of investor preference. Maybe, for example, like a privacy. So in your model, that affinity parameter BI might be related to privacy, right? So some people have they don't want to talk to many banks because they are concerned about the privacy. They only want to talk to their relationship with banks. So maybe privacy is a concern. So that as an extension to the price to each data point, to each consumer might be different. It's like a broader menu of the data points. So how that will affect the results.
Again, fair point. In the data cells, indeed, we are assuming that the bank cannot tell which data is buying, so the fintech has no incentive to tell them. If the fintech tells them, okay, here's the low type guy's data, the bank says, okay, I don't necessarily care too much because the low type get 0 anyway. But of course the bank get a different surplus. So I mean, we need to think a bit more about it. I think the quality of nature would go through if the data are sold separately of high versus low, and then the whole point is that the bank would price us informed, and we can leave the arrangement between the fintech and bank to be really flexible, right? Because we don't have a really strong view.
This may be related to BI parameter, not necessarily to theta parameter.
Yeah.
The privacy parameter.
The bank affinity parameter B is really about bank versus anything else. I think the privacy concern is probably in V, right? Because once your data become electronic, you worry about leaking it, and who knows what happened. I think it's more of in V, but I agree with you that the privacy concern could be already folded into the primitives.
Another question is about data ownership.
Oh, who owns the data? That's right. Sorry, I forgot. Yes, in this model, consumer owns data, but the fintech in the Wild West sell the data as if it's theirs. But then if the fintech is really doing a good job in reimbursing the value, the consumer says, fine, we are okay with this. But I guess in practical discussions, maybe the fintech is not reimburse the value. I mean, this actually the answer is not clear. I mean, what's the value for each individual investor's data? To the extent that the data help you run the model is probably not much, because you increase the data point by 1 doesn't really increase the power of the model by anything. But I think it's about individual credit quality. It's actually worth something. Yeah, that's something we also need to think about more. Exactly whether the fintech could be viewed as competitive and therefore reimburse the value. I mean. But in this model, when the fintech does offer exactly a single service, then one could, I think it's reasonable to say that they're going to compete away all the profits in the early stage. Wei.
Yes, I have one question as well as one comment. So the question is that in the public and the policy discussions, people worried about the fintech lending. A lot is because of systemic risk, right? Because you're not knowing how sort of when this new player come into the lending market, sort of this might increase systemic risk. Seems like from your model, my impression is that actually they lead to more information into the lending market, and they actually compete away some of the monopoly run by the bank. And in a sense, actually, in terms of systemic risk is neutral or maybe even improving in some extent, right? Is that right? So this is my impression. Maybe I don't, I still need to absorb the full model.
This is a great point. It certainly does take away the profit of the bank. And if we ask a central banker whether it's stabilizing or destabilizing to kind of discipline the bank, I guess people have different views. I mean, one way to make the banks really stable is to give them a lot of rents. But I mean, in the US system, at least, all the Canadian system, we see some Canadian friends here, is actually not too bad a thing to take a little profit from this really profitable banking sector. So I think this is a great point we should talk about, is that when fintech does something like lending, it certainly creates information, and indeed even the banks, all the consumers are basically priced as if they are informed. So the loan market total surplus certainly goes up, right? Because the low type consumers are no longer ration as much. I think that's certainly a positive in that sense.
Right. I also want to add one comment. So I actually have been looking at one data set, which is quite a unique data set actually is by Postal Savings Bank in China, which collaborate with Alipay, actually making loans. You know, Alipay make most of loans actually in the form of syndicated loan with sort of other smaller banks, not the large four-state bank. Actually, most because Alipay doesn't have a lot of capital, so most lending, 90% actually are syndicated loans with other medium or small size banks in China, right? So this is sort of a data set which is kind of interesting. Sort of Postal Savings Bank actually want us to help it to understand how this program compare with its own regular lending. So I've been sort of comparing sort of these two. In fact, actually, this is sort of it's a bit like your model, right? So instead, actually, Post Savings Bank, which is a traditional bank, actually have been working with Alipay. So it's not directly competing in that sense. But I am able to compare the two sets of loans, right? So actually, it's quite interesting. You know, there's some overlap, but the actual overlap is not huge, right? In terms of the borrowers in the two pool, all right? And the loan actually, you see that actually very different, okay? So even sort of among the overlap, some borrowers borrow from sort of the Post Savings Bank, the regular loans as well as this fintech loans because of the joint lending between Postal Savings Bank and Alipay. So you see sort of by just looking at this overlapped part of the sample, you know the Alipay involved in the syndicate loan tend to be actually have much higher interest rate, on average 14 to 15% interest rate. The Postal Savings Bank's regular loan about 8 to 9%. So there's about a 5% interest rate spread, right? So and some borrower actually can have access to both, right? So actually you see in the sample, some of the borrower borrow from both. So you wonder why would anybody want to borrow from Alipay, at the 5% higher interest rate, right? It turns out they do this anyway because many of them actually pay back really quickly. So even though the long term might be 6 months or 12 months, which is the two standard long terms, 80% of the sample, if I remember correctly, so the detailed number, so they pay back in a few weeks. So even though interest is higher, but they, most of these borrowers, they're not really intend to hold to the end anyway. So then that means effectively the higher interest cost is not that big. So this is actually kind of interesting. So Alipay compete with, not in this case, not direct competing, actually working with the traditional banks, but using a very different model. So they charge a high interest rate, but in a way, sort of, attracting certain borrowers who do not intend to hold the loan for a long time. So in that way, sort of, I think sort of they compete in different ways because suggesting that the fintech company, they have this ability because of the unique access to they can screen out a set of borrowers. They have special need, really like liquidity need, rather than, because they need the sort of a fund just for a few weeks, very short period of time. And it's so quick, easy, convenient to borrow, because you just sort of in a few minutes or few seconds, you can get it. And if you're just going to borrow for a few weeks anyway, so the convenience actually is a very important part here. So I think, and also we do look at the sort of default and stuff. Actually, even though sort of on average, based on traditional measures, sort of these borrowers have lower quality based on traditional measure, but default rate is certainly not higher. Even sort of looking at across the COVID period, sort of earlier last year, so China did experience sort of this severe economic condition, but across that, the sort of the default rate on these sort of fintech loans did not go above sort of the traditional loans. So in that sense, sort of, I think sort of from there, sort of information does tell you something about these borrowers, but actually there are multiple dimensions there, not sort of single dimension. So I think sort of a multi-dimension in the information, I think it's important to sort of bear in mind. And also sort of from here, I didn't look at the data for a long time yet. So based on what I've seen, so it seems like they compete on different dimensions. And actually, fintech loan, despite have a high interest rate, they are able to attract a very different crowd, and as a result, sort of risk does not necessarily rise rapidly. Okay, sorry, I don't want to take up too much time. So I should
really
have sort of something in written so that to share with you guys.
Yeah, thanks. It's really interesting. I think I mean, it does, I think, maps to the data sales better in our model because, in data sales, the interest rate spread that Ali is charging is kind of like the fee, whereas the banks, I can imagine that some borrowers might borrow from Alipay very quickly and then borrow from a bank in order to pay the Alipay loan because the bank is just much slower. But anyway, yeah, thanks. I look forward to, if possible, to have another conversation about this data, what you find there. I see Jonathan and Daryl. Please go ahead.
I just want to make a quick comment that seems to me your framework may be useful for studying central bank digital currencies and its impact on banks. Seems to me that when people talk about CBDC, most of the time they're thinking of very primitive payment instrument. So that looks like the fintech in your paper. One difference, of course, is that now instead of profit making, right, this CBDC issuer may be, I don't know, welfare maximizing. So maybe that's something you can, think about extending your model to study.
Oh, this is a great suggestion. Yes. I mean, certainly is consistent with the view that the fintech currently model is not trying to make a profit. One generally don't think the central bank tries to make a profit out of payments. Yeah, thank you for that suggestion, Jonathan. Daryl?
Yeah, thanks. So your focus here is on the synergies associated with information and data. Banking regulators like the Fed, though, have been focusing on the impact of payment fintech firms on bank funding costs. They seem quite concerned that if the fintech firms drive up competition for deposits that are used to make payments, that the increase in bank funding costs may dampen the enthusiasm of banks to make loans because now they have less profitable deposit franchises from which to get funding. But by the way, I'm yet to be convinced by that argument, but you didn't bring anything into your model about the cost of funding bank loans from losing deposits. Is that because you don't think it's important, or it's just too many things to bring into your model?
Well, thanks for raising the point. I think it's certainly possible to add in the model by saying that the cost of financing for the bank is increasing in the fraction of consumers actually getting diverted into the fintech space, into fintech payment providers. That's going to in equilibrium, prompt the bank to reduce the payment fee, I think, in order to retain that funding advantage. The reason that, one of the practical reason I've been alluding to it is that the US bank has been quite profitable anyway. I just very hard to find is a strong argument that we should keep extremely high profitability so that the financial system remains stable. I mean, if you want really, really stable, why don't we give them even higher subsidy? That seems to be a perverse argument. I mean, certainly US banks are not in the state of European banks or Japanese banks, so they are really in a good shape. I wouldn't worry too much about this, about the stability concerns right now. And yeah, go ahead, please.
I wasn't thinking about stability, but more just credit provision. By the way, I'm conflicted because I'm on the board of a narrow bank, but it's unrelated to payments.
Right.
But I think in your model, it will turn out to be the case that if the bank has to pay more for funding because of higher competition, it'll make exactly the same loans that it was already making because those are only dependent on information. So for a given amount of deposit funding, whether it's a high interest rate or a low interest rate, the set of loans made by the bank should be identical in your model.
I think that's, well, I need to confirm, but my intuition is the same as yours. Given that the banks have so many reserves, the cost, the opportunity cost of making the loan is essentially the LER, right? That's the interest rate that Fed pays them. So I think if we model that as a whole banking sector, when they make a loan, I mean, that's the opportunity cost of the funding, and I do not see why you know, the fintech diversion of a little bit of cash would affect their lending. Yeah, I like you. I guess I'm not too convinced that lending would be affected in this case, but we can certainly look at this and maybe try to model it. Lariana.
Yeah, you know, I'm referring to this issue regarding deposit. I have a model with Anjan Thakur where we are exactly looking to the role that banks are having in lending, getting funding from deposit versus fintech. But then if as soon as you include the deposits, you have the banking regulation. So you need to add also the cost of the regulation, because, you know, unless there are some arbitrage, as soon as the fintech companies are holding deposits, they need to be regulated. At least this is what usually we are thinking about, the difference between the banks with respect to any other type of institution.
Yeah.
Apart from the fact that they have deposit insurance, but as soon as they have deposit, they should be regulated. So you need to include in your model not just the deposits funding, but also the cost of regulation.
Yeah, that I certainly agree. For example, the cost of being a money market mutual funds, right? That needs to be registered because some of them actually kind of work this way. Yeah, fair point. So you are saying, Lorena, that it's not a simple change of the model. If you pull the string, the whole sweater comes off. Yeah, absolutely. Yeah, that's a fun discussion to have later too.
Yeah.